Okay, so we've got the markets. We're digesting some of this Black Friday, Cyber Monday fever, and then we're going to put that in the rear view. Come tomorrow when bank earnings season kicks off for the Canadian banks. It starts with Bank of Nova Scotia, and we've just been talking about how sentiment is pretty low going into these numbers, but so are the stock prices. Let's bring in Brendan Caldwell, President and CEO of Caldwell Investment Management, for some perspective. Thanks so much for joining me.
Good morning. Great to be here.
So what are you doing? You're going to buy them? Yes. Selling them, shorting them? What are you doing with your bank stocks?
They're a strong, powerful hold. The banks have been, it's a battle between the bad and the ugly for the last 2 years, which is an odd situation because normally when interest rates go up, that's actually good for bank stocks.
We hear that all the time. It's supposed to be great.
But we kind of got a double whammy for them because they've got not just interest rates going up, but the cost. They got tremendous inflation pressures.
Their own funding costs.
Yeah, and apparently their people actually want to start getting, what's the word in English, paid more money because, well, and you know, it's been weird. You've seen banks all of a sudden give pay raises in the middle of the year to their employees. So while they're trying to bring people back to the office.
I think they're unwinding that too now.
No doubt. And I think the speed toward even greater automation will continue. So you got that. And so you got the costs going up, both employment and interest rate costs. But then you've got this thing. You see, it's really a tale of two countries. In the United States, over the last several years, everybody that owns a house has refinanced their house at 30-year mortgages. They'll come due in the 2050s. In Canada, we're a lot more pro-bank, so they don't want to be locked into a bad interest rate environment for 30 years, so they make us renew it at the maximum every 5 years with a lot of people with floating rates. So now in the next 3 years, everybody that has a low interest rate mortgage is going to see that come due at much, much higher rates. So in the U.S., the banks have already bought, sold, dealt with all their mortgage issues. But I think we're going to have a rolling problem here in Canada the next 3-5 years.
So are you saying that you would, if you're buying banks, you're skewed to ones with U.S. exposure?
Certainly the BMO is one of our...
Because that's one of the worst performing banks so far this year.
Oh, yeah. No, as I say, it's between the bad and the ugly. I mean, I think over the last 2 years, BMO is down, give or take, 28%. But it's BMO Harris and now the Bank of the West acquisitions in the U.S., could mean that that'll mean that'll be 35, 38, 40% of their earnings will now be from the U.S. But I mean, we own J.P. Morgan. And
if you want a U.S. bank stock, buy a U.S. bank stock.
Yeah, and we also own the Royal Bank because it's been the least ugly the last couple of years. I think it's only down maybe 18% from its highs, bounced maybe 10, but most of them have bounced 8 or 10. Doesn't yield very much relative to the others.
That's right.
4.5 odd percent, not nothing to sneeze at.
I think the highest one, or among the highest ones, are Bank of Nova Scotia in terms of yield.
Yeah.
Well, and they've also sold off quite a bit. That's how these things tend to go.
Yeah, 7 odd, I think, Bank of Nova Scotia yields.
And CIBC as well.
Yeah.
Are those interesting to you?
Well, no, we would rather trajectory than absolute numbers. So you got a company with a 6-7% yield. That's wonderful. Now, cutting a bank dividend is a career-limiting move.
Oh, it's not good.
So it ain't going to happen. It didn't happen during the financial crisis. It isn't going to happen now. But you're not going to see the same increases, I don't think, from Bank of Nova Scotia or this. I would sooner those 6 or 7% numbers than say Laurentian Bank's 7%.
Yes. That's the worst performing.
Sked 2, Sked B, B-lister banks, their earnings come out, I think, next week. Funnily enough, the National Bank, which is
it's held up.
It's actually been, I think, over the last couple of years, the best performing. It's merely down 10 or 11%. I think it's curtailed its international investments, and which I mean not outside Quebec, but South Asia and these sort of things. So, no.
What do you think about the momentum in some of stocks that you think should be under the most pressure, like EQB, like Canadian Western Bank, and those have put up huge numbers so far this year?
Well, I think if you've got a specialized area that you're doing in financial services. So I mean, one of the companies we own is Element Fleet Financial.
Yes. Okay.
So if you're financing in an area, you know your area, and it's not about the general economy and how mortgages are going to go, but how your particular sector is going. So take Element Fleet, which finances auto fleets. It's benefiting from a resurgence in the economy. It's the fact the auto companies aren't able to deliver. They're winning new business from big corporations. So in a particular sector, you could do very well. And so there's Canadian Western Bank, at least in Toronto, was our neighbor for a while.
Yeah.
There, you would have thought that the West would have been under pressure, but the energy sector's actually had something of a recovery, and the CWB perhaps with it.
So you're nipping away a little bit at some of these bank stocks, or at the very least holding the ones that you own. It
yeah,
sounds like
no,
Royal, BMO.
Yeah, you're completely putting words in my mouth, but that's
No,
okay.
no.
We own some Royal. That is true.
You own some Royal, not BMO. You own BMO.
I've chatted with our two portfolio managers that are keenest on the banks. One loves the BMO because of its American exposure.
Yeah.
The other loves a stretch, tolerates the Royal because it is the biggest, baddest, most dominant, politically active 800-pound gorilla in the Canadian banking sector. And how does one say this? Nobody ever got fired for buying Royal Bank.
So but it sounds like you're still relatively underweight relative to the market.
So like we have a fund that does Canadian momentum stocks or Canadian value momentum. We don't own any banks in that strategy. We own instead
Fleet?
Yeah, well, other strategies. We have owned Element Fleet, and we may be looking at that again in that strategy. But so many other sectors of the Canadian market are doing better than the financial services. And until they get the handle on this loan loss business, which I don't think is at an end, as I mentioned, given mortgages.
This is a Canadian value momentum fund?
Yeah.
You try and do both at the same time?
Yes, it's awesome.
Give me an example.
See, Canadian stocks people get really excited about them. Take a Shopify,
yes,
which we should have
which
owned.
I don't think you call that a value.
Well, no, so we don't own it.
Yes.
But with a value company, particularly in Canada, it could be years before somebody realizes my brilliance in owning that stock.
Right.
And that's a best case scenario. What normally happens is something I think is good value becomes better value, and better value, and better value all the way down. To use the most Canadian analogy possible, what we like to focus on is the curve of the hockey stick, where it's a good value stock that the market has just started to re-rate, just started to think of a little bit better. So, and I don't even know necessarily what the reason is. It could be there's a median earnings revision, so the median analyst has revised her numbers up. It could be that that there's something going on behind the scenes that we simply don't know about, that the market has just started to appreciate.